Hi, everyone. Welcome to our webcast on the impact of Trump policy and the readjustments following the abrupt tariff introduction by the US. We want to cover a lot of topics. This is not just about the tariff rates. It's really a geopolitical stress test. And this geopolitical stress test has pushed relationships between the US and other countries to the limit. We have some takeaways that we want to discuss with you today. Let's start from these 5 key points. The first one is the world is going to be driven more by fiscal spending. Despite the focus on tariffs, the most important point that we have seen in the past few days around US policy is the tax proposals. Fiscal deficits continue to be high, and you want to invest alongside with governments, both in the US and in Europe. Europe as well has launched a very large-scale fiscal plan, both from Germany and other countries. So that's a key point to discuss. Number 2 is inflation is going to be persistent. We're no longer in transitory territory. We've been for over 48 months above target, and investors will need to deal with lower real rates in paper assets. So with that in mind, we want to create a portfolio. We want to position in assets that have real upside, not just nominal upside. There's going to be also a continued flow of diversification from the US into other assets. Now, if we look at the pot of global equities, that's 100 trillion. Global bonds, that's another 100 trillion. Over half of that is US assets. So what's going to be challenging here is to find other diversifiers. Gold, for example, is only 20 trillion. So if you just move a few percentage points from US assets to gold, that's going to create a huge upside in that. And the same for Europe. European equities and bonds market cap is a lot smaller. So even a small amount of diversification could create a lot of upside in non-US assets that are undervalued. Number 4, assume no safe havens. This is connected to number 3, but essentially governments have too much debt. And the crisis that we're seeing today, the movements in the markets, these gyrations are essentially a symptom of the fact that the West has been spending too much, continues to spend too much, and cannot finance itself. As a result of that, we have high inequality, we have a lot of political issues. As a result of that, the tariffs are an attempt to tax other countries to maintain a high level of spending. The geopolitical stress test that the US has implemented failed, and the tariffs will not compensate for the full amount of the US deficit. Far from that. The US deficit will continue to be in the mid to high single digits. So owning public debt here, owning duration, is a risk. It's a risk that your capital will be eaten up by inflation, but also a risk that inflation will become entrenched and curves will steepen. So we don't want to have duration here. And finally, we want to stay in liquid assets. The optionality that liquid assets give you is huge in this environment. A lot of allocators have put assets in the US, and a lot of that overweight has gone into privates, both in equity and in credit, with relatively low returns, adjusting for leverage and for beta. The optionality that we have in liquid assets is amazing in environments of uncertainty where investors are able to trade this volatility and benefit from the embedded risk that we have in these moments of policy uncertainty. If we look at the long term, if we look at the fundamentals, we'll talk about it, then the returns that we can get in asset classes can be enhanced by the trading and the volatility that these moments generate. So let's talk first about the economy for a few minutes, then we'll talk about markets. First of all, the problem the US is trying to solve is that China has been eating up the world's manufacturing capacity. They've been producing more and more. And that's a trend that is a long-standing. The US was already falling on global manufacturing capacity for decades. But China has clearly captured and improved in quality. And in the context of a larger geopolitical conflict, the US feels threatened. The US wants to draw a line in the sand, isolate China, and redistribute manufacturing capacity in other countries. So the tariffs are only a small step in this direction. Historically, we could almost see this as Athens, essentially in the times of the Delian League, Athens trying to gather the allies under its banner. The US is doing the same thing. It's telling other countries, you're either with me or without me. And classifying countries in a traffic light framework where some countries are green and some are yellow, and the red one is China, and trying to get as many allies close to it as possible. However, when we look at the tariff impact and the distribution of tariffs around the world, of course, the headline and the average tariff is going back up to an average level, to a high level. However, what will happen in practice is that supply chains will be rerouted. In other words, if Chinese goods are taxed and tariffed at 300%, those goods will not be bought by US consumers. There will be other goods that will substitute those goods. So US consumers will buy from Mexico, will buy from Europe, will buy from the UK. So overall, there is a loss of trade. There's a loss of wealth. There's a tax on consumers, especially the weakest consumers. However, there are also winners. And those winners are regions in the world that have manufacturing capacity outside of China, independent countries, independent regions. And those winners are Europe and the UK, for example. And also, to some extent, Mexico we see as unaffected. This is an analysis from Yale University, from the budget lab at Yale. And there are similar types of analysis from other sell-side institutions. It is impossible to forecast how trade will be rerouted across different regions, but it is clear that in an attempt to isolate China and tariff China a lot more than other countries, that tariff rate on China will not be paid in the long run. What will happen in the medium and the long run is that trade will be rerouted to other countries. And as a result, the impact on growth from tariffs becomes actually smaller the longer tariffs stay in place and the higher they are. Because the higher they are, the least consumers will actually pay that tariff. What this means is very simple. Consumers would pay some of the tariffs in countries that have a 10% tariff or a 15% tariff, but will not pay to buy those goods that are tariffed at 200% or 300%. The tariffs will not raise as much money as the Trump administration has been discussing. The average tariff rate will be lower, will be closer to 10%, more like 15%, not 25%. So not the exact weighted average of tariff rates at current trade levels, but a new weighted average with new trade levels. And as a result, deficits will stay high. So if we have to think about the two risks that the markets is toying with, is focused on, there's on the one hand the risk of recession, of sudden stop of a 1929 crisis. And that's been discussed by sell side and media pundits. And on the other hand, there's the risk of persistent inflation and debt monetization. Well, we are a lot more worried about the risk of persistent inflation and debt monetization, and central banks stepping in to cut rates as a result of these gyrations and entrenching inflation rather than a sudden stop in a recession, simply because we have seen that the Trump administration is limited in its negotiating ability. They will not want to self-impose a deep recession. The result is that some consumers will be hurt, particularly the low end of the consumer, will be hurt by inflation and by tariffs on a larger share of their disposable income. So there will be winners and losers geographically and within the US population. But the result is also that deficits will continue to stay high, will continue to rise. And the real news that has been under the cover in the past few days is the tax proposals in the US, which include no tax on tips, for example, and include an extension of the tax cuts. And the CBO projection for deficits levels is still in the mid to high single digits. The major worry for the US Treasury Secretary and the US administration remains the long end yield. In an environment where growth fears have spiked, the long end yield for the first time in a long time has moved together with risk assets. And there are profound implications of that. And this is what has scared the US administration and pulled them to walk back. But the reality is that in an environment of very tense geopolitical dynamics, governments cannot afford to trim spending. There are some things that will stick. There are some dynamics that even if the Trump administration walks back completely from its stance, will stay. One of them is governments will continue to spend. Germany recently launched a plan which is over 650 billion euros in spending over a period of 5 to 10 years. It will be followed by country-level spending and EU-wide level vehicles for a total of 1.3 trillion euros, or even potentially larger than that. And this will lift European growth over the next 5 to 10 years. It's historic and it's a change in framework because Germany has, for the first time, opened its wallet to an open-ended investment plan where everything that goes above 1% of GDP spending for defense will be out of budget. So there's a historic change even in the European spending fiscal space. And finally, China has recently boosted its total social financing and its potential increase its deficit. So what do we see today? If we take a step back from the volatility of the tariffs and the headlines, what we see is that we have an environment where governments are spending the same or more than before. There's been very limited impact from the DOGE tax cuts, spending cuts at the federal level in the US, and more tax cuts are coming. The EU has just launched, together with Germany, a historic spending plan. China is revamping total social financing. At the same time, central banks are cutting rates. They're backward looking. They have been looking at inflation declining. They think they have room to cut. And in particular, they're also looking at the recent gyrations as a reason to cut further. So we have monetary and fiscal policy, again, going in the same direction in an environment where inflation has been potentially above target. So what are we worried about in markets given this framework and going beyond the impact of the recent volatility from tariffs? Well, the first thing that we are worried about is that there's going to be a de facto de-anchoring of inflation expectations and a de facto abandoning of the inflation target by central banks. We've been for a number of years now, a number of quarters above the target in the US and in the UK, and central banks are cutting. So there is less focus on inflation mandate. There's a lot more tolerance on inflation above 3%. And this is the first time that we've seen this on a coordinated global level in a long time. Are central banks going to worry about inflation now? Are central banks going to be hawkish? There's no intention yet to do that. There's still a major focus on the unemployment part of the mandate from the Fed. At the Bank of England, similarly, even if inflation is very entrenched, there is more focus on growth. And the ECB, which is more focused on inflation, is got a lower inflation problem until now because it's not pricing in the impact of the stimulus, of the fiscal stimulus. So we continue to see that there is a gradual abandoning of the inflation target, or less stringent abandoning of the inflation target. And there is a lot more focus on containing the long end of curves, of yield curves. When the long end of curves rises, then what central banks do and what Treasury officials do is to shorten maturities, reduce quantitative tightening, and potentially introduce an implicit version of yield curve control. So verbal forward guidance, potentially at the margin, at the limit, it will be a return to quantitative easing or potentially interest rate cuts. This creates depreciation of currencies that we are showing in this current chart with gold going up. We've seen obviously a depreciation of the dollar more aggressive than other currency, but over time it creates a depreciation of currencies. So how do we think about markets after the volatility induced by Trump and by this geopolitical stress test fades? You know, how are the different boats going to be when the big wave of volatility, you know, fades and the sea level comes back to where it was before? Well, what we see here is that some of the moves in markets have already retraced. The first thing that I think will continue to retrace is volatility. Implied volatility needs to come down. There's been a lot of index level hedging. And in Europe in particular, we are at the all-time short risk positions in credit. So there's been a lot of index level hedging across options and across derivative instruments. And those will be the first ones to fade, to normalize, because the tail risk of a very aggressive negotiation has essentially, for now, you know, has gone away from the picture. We have seen more extension of deadlines, but we're seeing also today more opening from China for a negotiation. We have also seen an opening of US officials in the negotiations around Ukraine, where the demand on minerals has been dropped from 300 billion to 100 billion. So more reasonable demand on future mineral extraction in Ukraine. Essentially, the US administration has gone from a very aggressive, you know, art of the deal, pounding the table with your fist, first phase, to a more rational negotiating phase. So volatility and tail risk of a recession, in our view, are overestimated in this environment. But then the question is, what will happen to other asset prices? Will we have a default cycle? Will credit start and continue to widen over the year? We will have defaults. Will equities go down? Are we going into a recession? There's been a lot of, a very wide array of forecasts from sell-side economists and a lot of panic. And some have forecasted a recession in the morning and then changed their forecast in the afternoon. But let's look at valuations. What are markets pricing in? We're back to above median levels for spreads over the past 10 years in high yield and in investment grade. So there is some level of stress priced into markets, particularly in some pockets of the market. For example, high yield, for example, some of the more cyclical sectors like autos or industrials. And we have to say that credit markets got into this tariff announcement in a much stronger position versus where they were 2-3 years ago. Corporate balance sheets and household balance sheets are strong. Companies have refinanced all the maturities they had in the next 2-3 years. So there's very little debt maturing for the next 2-3 years, and corporate leverage has come down. Similarly, consumer leverage is relatively low, especially in Europe, like corporate leverage, and consumers have mostly funded with a long-term fixed rate mortgage when yields were low. So this is essentially a public debt problem. It is not a private balance sheet problem. As a result, it will be solved with a one-size-fits-all tool by government. It will be solved, in our view, in a monetary way, not in a micro-structural way with defaults on companies. Having said that, we do forecast an increase in defaults, and we do forecast that increase to be gradual across both Europe and the US. There are credits that restructured and didn't restructure enough. There are credits that benefited from large inflows of capital into private debt funds, which then offered them very easy conditions to refinance. Companies that couldn't fund and refinance in public markets got financed by private funds. And these companies will have to restructure again. There are sectors which are vulnerable. There are sectors where governments will have to cut spending, for example, welfare, and that will spill over to lower consumption. So we do see that defaults will gradually rise. We do see the potential for a quarter of slower growth, but we don't see a recession. We don't see a tail, and we see that start and stop that created a lot of hedging over the past 2 weeks, easing with investors being overhedged right now, both in derivatives and in Delta One derivatives, as well as in volatility. If we look at what happened on the flows over the last few weeks, we had essentially over a year of flows erased by outflows very quickly. And we have had the largest all-time record short positioning in European credit, which you can see here shown by the crossover, the European high yield CDS index. So definitely fundamentally a relatively stable picture in the private sector, a long-term troubled picture in the public sector where there's too much debt and governments continue to spend. A lot of fears of recession, but in our view, the real topic here is how the monetary system will be rebalanced, how assets will be rebalanced from the US to other countries, and what will be the new safe haven assets and how to construct portfolios and invest in this environment. So what are our conclusions? First of all, credit has become a really interesting space in the past few days, in the past few weeks. We had a long time of low volatility and we were relatively cautious, especially on US credit. We continue to be cautious on US credit where there is weaker quality and more fragile fundamentals. But we think the opportunity set has opened up with a lot of relative value, a lot of dispersion, and also higher valuations in general, and a lot of mispricing. Even companies that have support from governments or shareholders have sold off aggressively. Even companies and countries with a short-term catalyst, for example, Ukraine, which will receive potentially more aid by Europe and maybe even a more favorable negotiation with the US, have repriced very aggressively. In a liquidation event, good and bad names have repriced indiscriminately. So in an environment where governments continue to spend, central banks are easing, deficits and inflation are persistent, you want to have your assets in credit. And within credit, you have volatility, you have dispersion, you want to have some in liquid. You don't want to have some in private that is locked and that gives you only a single-digit net return without the optionality to capture volatility. So credit has become interesting. We think this is a geopolitical stress test. The US has in part failed this stress test. The aim of the Trump administration is to isolate China, to gather more allies under its banner, to diversify the productive supply chain of the world out of China, which currently accounts for most of manufacturing capacity in the world, and also with Taiwan could capture even more capacity in the semiconductor space. The beneficiaries of this are other countries that have a manufacturing capacity like Europe or the UK. There will be losers, but there's also winners. From an economic perspective, therefore, we cannot think of the tariffs of the weighted average of the tariffs applied times the current flows that were happening in the past. trade flows will be rerouted, and the result would be a better relative value in countries for goods in countries that have cheaper tariffs versus countries that have higher tariffs. So essentially, people will buy goods from countries that are tariffed at the lower level, that cooperate more with the US. This rerouting of flows will determine the average tariff, and that will have a lower impact on growth. It will not be a sudden stop. It will not be a hard recession. What we're really thinking about, however, is what happens after the waves comes down. What happens after the wave of volatility is gone. And we think it's a world where, yes, the US has still a path to be exceptional, but investors will want to be more diversified. And as a result, you will want to have, first of all, you will want to have investments that are supported by governments, like infrastructure and defense in Europe, where the spending plan is very large. Secondly, you will want to have investments that are linked to real upside, not just nominal upside. So not just credit, but also, for example, convertibles, or bonds that have optionality on cash flows that correlate positively with inflation. Thirdly, the US Treasury bond and generally government bonds might no longer be the safe haven that they were in the past. Correlation with risk will be more likely positive than in the past. And yields typically will not compensate for inflation. So as a result, you want to construct your portfolio in a different way from the past. You don't want to have a balanced portfolio. You don't want to have a risk parity portfolio. You want to have a portfolio that is nimble, and it's long short, and it's liquid. And finally, you want to look at Europe as the potential winner out of this rebalancing of global trade. Europe, for the first time, has launched a more unified strategy, which will not just cover an amount of spending, but also consolidation across key industries, which include banks, energy, infrastructure, space, and telecoms. It will unify capital markets union. The wheels are in motion for capital markets union and banking union. And finally, it might also get to a more cohesive, common fiscal framework. These are, very long-standing objectives. But what we can say already is that the first part of this path, so spending and consolidation across key industries, is already there, is already happening. We're already seeing M&A in the banking system, in telecoms, and so on. Later on, we might see a fiscal vehicle, we might see a path towards banking union or capital markets union. These are longer-term objectives. But as we saw before, the bar and investor expectation, the positioning is extremely low in Europe. So we can only be positive on that side. So after this wave of volatility has created opportunities, we're pretty excited. We think the opportunity set is pretty attractive. There's not much positioning here. A lot of investors are still focused on the US side of the credit market. And we're here to answer your questions. And feel free to put them in the chat, but also to email us over the coming weeks, and we'll be happy to help.
Thanks, Alberto. So I think there are several questions. I'm going to summarize them in two, one for you and one for Tao. So just starting with you, given that we've spoken with a number of investors over the last few days and number of market participants, where do you think people are most overweight, where are people most underweight, and how do you think the market will be looking to reallocate risk as we come out of this volatility?
Yeah, so I think that if we take a very broad look, the US equity and US bond space are 100 trillion altogether. So the winners, from what we are hearing, are European assets and Japanese assets, right? And so there's been some reallocation there, but it's been still slow, I would say. So there's a lot of room for reallocation. I would say that in our process, there's two things that are key apart from credit analysis, which we always do, and it's geopolitics, number one, and also risk management and volatility. So when we see large shifts in market sentiment, we're always trying to focus on the long run. Mark to market can be sensitive. Mark to market is a great thing. You know what you're buying. You know that you're buying it at the right price at that time. Not a private asset that's not marked, and that's great. But we think that the long-term impact is actually a bit different here from what investors have been thinking about. What investors have been thinking about is essentially, oh my God, we have a recession, I have to hedge. But the reality is that we're actually having a new world order which is going to be a different shape from what we are used to. Not necessarily with a recession in it, but maybe with persistent inflation and maybe with a reallocation of capital. So we have 50 trillion in US equities, over 50 trillion, we have 50 trillion US bonds, and that's, over half of the world's assets in equities and bonds. We only have 20 trillion in gold. The European credit market is still much smaller than the US market. So if these flows go away, the first thought I have is that there's not enough space. So you have to go into those other assets that you want to buy relatively quickly before they reprice.
And if I can just follow up on that, and a slightly technical question which we're getting is, when we think about how investors were positioned coming into this, do you think certain FX trades, such as people being funding through hedge currencies like JPY and CHF versus sort of buying dollar assets, has exacerbated the moves?
There's been a lot of theories about price action. What I think has not happened is central banks selling US treasuries. I think that's not happened. But there's definitely a lot of crowded carry trades that investors, funds were performing, were holding, including basis trades, including FX carry trades. There's a lot of strategies that might look risk neutral, but in reality have an embedded liquidity put option. For example, doing a basis trade between bonds and futures, or between credit and CDS. Those are all trades that look neutral on a model basis, but actually embed a liquidity put. And the risk of that liquidity put being triggered in these moments, does not compensate for the amount of carry that you get entering those liquidity puts when spreads are tight. Doesn't compensate for losing the opportunity for buying or trading the market in these times of uncertainty. And as we have discussed for a long time, our process is based on taking advantage of this volatility, of the fact that the world is a more uncertain place, will continue to be from a policy perspective.
So that's super helpful. And for the closing question, Tao, if I summarize a few of the questions, how we've seen we've seen different responses from the Chinese government. So Xi this morning came out and said he's open to speak after previously saying, maybe not. So how should we be thinking about the way that response will be going forward from the Chinese side?
Sure. Thanks, Eddie. I think first of all, the Chinese government, they don't have much incentive to be soft this time, because it is better position to play a long game here, because they don't have the election risk, like for example, the midterm election, they don't have that risk. And this time, in terms of the financial markets, the Chinese market is also better shielded than the US market, like we discussed from here. So first of all, they don't have incentive to back off very easily. And second, what they will be doing, I think, first of all, they will focus more on increasing domestic easing. They could be doing more credit easing through cutting the reserve requirement ratio, and most importantly, increase fiscal spending to improve infrastructure investment and also to support consumers. And also, at the same time, another thing they could do is depreciating the Chinese RMB. What we have seen in the last round of trade war in 2018, in the year from peak to trough, there is like a 14% depreciation of the CNY. This time, from November, the US election last time until now, the depreciation is only 3%. So that means there is still more room for currency depreciation for China to do. And in the most extreme case, they also have like almost a nuclear option, which is to make use of their UST holdings, where they are the second largest holder of US treasuries. They don't even have to sell a lot, but just enough to cause some volatility in the US market, which could put more pressure on the US government. So I think these are the options the Chinese government have, and also in terms of the order, it's more likely to start with moderate currency depreciation, and in the extreme case, the use of the treasury holdings.
Thanks, Tao. So essentially, I think we have a double dynamic here, because the game the US has been playing has encountered a much stronger adversary in China that obviously is prepared for this and is essentially taking a longer negotiation on the table. Today, we had some opening headlines from China that had softened the approach. But essentially, because China does not step back, the negotiations with every other country has become a bit easier. So we'll have a situation more likely where the US is speeding up and having easier negotiations with Europe, with the UK as well, with Vietnam and with other countries, and then we'll focus more on China. In this framework, in this game theory framework, the US will also likely need a win. And we think that potentially the ceasefire between Russia and Ukraine is that political win that Trump needs in the meantime. And that's why the demands on Ukraine have been reasonably lowered. So overall, we are looking at a more prolonged negotiation with China, but not at a sudden stop with the rest of the world, as we were discussing, and as the market for some time was worried about. I don't believe there's any more questions. So I would say, closing with these points in mind that are still, core in our thinking and in our process. We are concentrating on sectors where governments are supporting and where governments are investing. We want to have real upside, so not just credit, but alpha, of course, and also upside in assets that are correlated to persistent inflation and that do well in a persistent inflation environment. We want to diversify outside of the US. We've been more positive on Europe than US credit. We continue to have this view in our process, in our strategy. We don't use duration to stabilize our returns. In fact, we've been negatively biased on duration. And we continue to be, but just in the US, not in Europe, where yields have widened substantially. And finally, our portfolio remains liquid, our strategy remains liquid, and we're very eager to capture volatility and the next rounds of dispersion over the coming weeks, if they will come. Thank you very much for listening. Please feel free to ask us questions, to email us, and as usual, good luck over the coming weeks. Thank you.